Hey gang, welcome to Time in the Market, the investing channel with a long-term focus. Took a bit of a break, was a bit busy with life, but now back with another video about PayPal. Just listened to their earnings call. The stock is down about 2% after Q3 earnings came out. Was down as much as 5 to 6% before the call, so the call had some positive movement on that number. The call itself was pretty decent, I thought. I like what the new CEO is doing, and the earnings aren't too bad. So why is the stock down? Well, they do have a miss on the top line. Total revenue coming in at about 6% growth year over year. The expectations were closer to 7%. However, on the bottom line, non-GAAP EPS up about 22%. Expectations were closer to high single digits, so 107 expectation beat by a 120 non-GAAP EPS number. Really, the important thing to me as an investor in PayPal, I do own shares in PayPal. I made some videos about this company in the past. The stock is up 63% in the past year, up about 36% year to date. I was a buyer in the mid 50s, low 60s. Not really a buyer now, but I am a holder, and I feel like these earnings just reaffirm my thesis that this is all about transaction margin, and transaction margin is starting to grow again. Before Alex Chris came in, transaction margin percentage, transaction margin dollars were shrinking. Now they are growing again, which is really good to see. You can kind of see the accounts are growing as well. This was a bear thesis for quite some time, that this is a company that's on the downward slope. They're dying. People aren't using PayPal anymore. And yes, the accounts were shrinking for a bit as they were getting rid of old inactive accounts, but now you're starting to see that number grow again, which is good to see. Not something I pay attention too much to, but it is good to see that more people are using PayPal and all of that. Really, the snapshot here, payment volume continuing to grow at a good clip, transaction margin growing at 8%, 6% without customer balance interest. That's really nice. Non-GAAP EPS growing, free cash flow growing. And this is really the thesis as well. This is a company that generates a ton of free cash flow, still trades at a reasonable-ish free cash flow yield. Very reasonable compared to the rest of the market, given that it's still a growing revenue company. And they're buying back a ton of shares. When this was trading at a 10% free cash flow yield, to me, this seemed like a really easy buy. Now that it's in that 7.5% range, kind of a bit murky because they do have some challenges ahead, but still a very interesting company to hold. Probably not a buyer now, but we'll take a look at a valuation in a second. As you look at what's driving their growth, and this is really making clear why their revenue is shrinking a bit. They're not focusing on unbranded card processing growth at all costs anymore. You can kind of see what was driving growth before in Q3 2023, 32% growth from Braintree. This is their unbranded card processing product, really the back room of the card processing for larger companies that are not wanting to partner with a branded checkout. Growing at 32% then, down to 19% last quarter, now down to 11% this quarter. Really, their strategy now is to focus more on profitable growth versus growth at all costs. So they're renegotiating some of the contracts as they come up for negotiations, getting better deals, focusing more on other services they can package with Braintree, getting good placement for their branded checkout, things of that nature. Branded checkout continue to grow well. Venmo continue to grow well. Other merchant services growing at a good clip, becoming a bigger part of their business. I think a lot of this stuff is going to gain momentum as they sort of package all of this together and build out a suite of products that are going to make the product easier to use for users, but also more beneficial for merchants. And that's going to be interesting to see in the coming quarters. They really talked about how their focus is no longer at growth at all costs, but really focusing on a price to value strategy and prioritizing profitable growth. And that's kind of outlined in their guidance for Q4 2024. Low single digit growth, probably a bit lower than I expected. But again, it's like, what are we focusing on? We're focusing on making money versus just growing revenue. And that's going to lead to improved margins, improved transaction margin dollars, better non-GAAP EPS, better GAAP EPS, but lower and slower top line growth. So as you look at their full year guidance, they're probably going to grow slower than the market expected for 2024, potentially slower for 2025 as well. But the benefit of that is going to be better transaction margin dollars. They're taking their low to mid single digit growth to mid single digit growth guidance. So up there, up on the non-GAAP EPS, up on the GAAP EPS, free cash flow unchanged, share repurchases unchanged. So really focusing on improving transaction margin, and then maybe in the future, as they release these new products, as they package it all together, that's going to come together and help revenue grow again. But I think the reality is in the short term, you're going to see revenue slowing, but non-GAAP EPS, GAAP EPS, transaction margin dollars, transaction margin itself starting to grow again. And it's good to see. You can kind of see transaction margin here really down a lot in the last year, always negative for the most part, and now starting to grow again. Again, 1% growth, -3, flat, up 4%, up 8%, up 8%. That is a good thing to see as an investor. Transaction margin up for the first time in a while. 46.6%, the highest it's been since probably like 2022, the latter part of 2022, which is really good to see. Transaction take rate overall still continuing to shrink. Transaction take rate and total take rate, because they're working with larger and larger businesses on the Braintree side, and I think they really want to focus on more growth in the small to medium business side when it comes to Braintree as well, and that's going to hopefully improve total take rate. But I wouldn't be surprised if this continued to shrink a little bit more in the coming quarters as well. But still, as long as payment volume keeps ticking up, as it has been, even if it slows a bit, the total dollars should come through even as take rate comes down a little bit. So overall, what's the thesis here? What is the goal here? Again, this is a company that's trading at a reasonable clip still, 7 to 7.5% free cash flow yield. Not too bad in this market. They're using the free cash flow they generate, a ton of it, to buy back shares. In 2016, they had 1.2 billion shares. At the end of 2024, they're going to have 1 billion shares. So they basically shrunk their share count by 17, 18%, something like that. If you look at their estimates, still growing at a decent clip. Again, these estimates will probably come down after these earnings, but again, mid to high single-digit revenue growth for a company that is improving margins on the bottom line, generating $6 billion plus in free cash flow, using all of that free cash flow to buy back shares. Pretty interesting investment, even at today's prices. As we look at the valuation here, disclaimer, this video is purely for informational, educational, and entertainment purposes only. It is not investment advice. Please do your own due diligence. So again, company buying back a ton of shares, about 3 to 4 billion every year for the past 3 years. This does include stock-based compensation. So when you look at their earnings release, they say we're going to buy back $6 billion worth of shares this year, but they're probably going to issue $1.2 to $1.5 billion worth of stock-based compensation. So that's some offset to that. So keep that in mind. They do not pay a dividend. I do believe, however, that in the next year or 2 or 3, they are going to start paying a dividend, become a dividend payer, because there's only so many shares you can buy. When the valuation kind of gets more reasonable, the stock buyback becomes less attractive. However, the stock buybacks for the last year or 2 have been really attractive, and I think has been driving the stock price increase, as well as the improvement in business metrics. So when you look at my assumptions here, again, I'm showing slowing revenue growth, worse than the estimates for the next couple of years, and improving margins, but margins that are less attractive than what the estimates are showing. Again, as you look at the out years, those estimates become less aggressive. When you look at the valuation, about a 7% free cash flow yield based on the assumptions for 2024, based on today's market cap. The number of shares is down to about 1 billion now, going to continue shrinking as they buy back shares. 50% of their free cash flow going to go towards buybacks. I think that's probably conservative. You can probably make this closer to 75 as they're using more and more of their money towards buybacks. However, I do think some acquisitions might be in play for sure. They have the balance sheet to do it. They have 18 billion in cash, some of it restricted, maybe 2 to 3 billion restricted against 12 billion in debt. So they can handle an acquisition. Not sure they want to do that right now, but in the next couple of years, certainly an opportunity there. And then as you look at, hey, if the economy slows down, can they handle that? Yes. Their balance sheet is really strong. They have the free cash flow to buy back shares when they get cheaper. They've been buying back shares all along. So as I look at valuation here, what's the right number? You can play around with the spreadsheet. Just hit file, make a copy if you'd like. A target return of about 10%, a 6% free cash flow yield gets you to a fair value of about $93. If you take it up to a 7% free cash flow yield because you're more conservative, gets you to a fair value around where it's trading at today. An expected return in that 8 to 20% range, depending on where your fair value comes into play. Is this a company that could trade at 4 to 5% free cash flow yields again, as it has in the past? I think so. It all depends on what they do with their top line. I think the market needs to see a return to growth. The reason the stock is down today is because they're shrinking a bit faster than the market expected, or their growth is shrinking a bit faster than the market expected. They're still growing. I mean, this is a company that's growing at mid-single digits, trading at a 7% free cash flow yield. There's plenty of companies out there today that are trading at a 3 to 4% free cash flow yield and growing at zero, and the market seems fine with that. I think people are still worried about PayPal and where it's going to be 5 to 10 years from now. One of the questions that came up around their new strategy around Braintree is that they were a price leader before this new strategy of focusing more on value and making sure that it's profitable. Are they still going to be a price leader? And the answer they gave kind of gave me some pause, because they basically said, well, I think we have a lot of services that add value to merchants, and we can pair those together and still be the go-to player. But they didn't really answer the question, and didn't say that, yes, we are still the price leader. Yes, we're still going to get primary placement for branded, for unbranded, etc. Somebody else could come in there and sort of just underprice them, undercut them, and really cut into their growth. One of the other things that I've noticed is that a lot of these virtual cards online, like Google now prompts me to sort of select my virtual card that they create for me based on a card I've stored there in the past. And I've been using that a lot more than I've been using PayPal. So that's a bit concerning as a user who was also an investor. Because of that, I'll probably be a bit more conservative around my investment here and place it in that 7% range, and knowing that I already own a good portion of these shares that are, 50 to 60% up from where they were before, I'd probably need something closer to a $70 price point to buy more. But I do feel like this is still a good value. I feel like this is a stock that's headed to $100 in the mid to longer term. So I don't think it's going to be there tomorrow, because the market's going to take a while to digest this. I think they're going to be a bit conservative until they see the investor day in February and see what they say there around 2025. One thing that they said around 2025 is they expect the transaction margin dollar growth that they saw in 2024 to be sort of the baseline for 2025, which is really good to hear as an investor. So there's some positives, maybe some negatives here, that make me feel like I'm in a good spot with my investment. I don't want to add more, but I'm completely safe holding it. I feel completely good about holding it, and expect this to be a $100 plus stock in the medium term. Again, if I'm looking at 7% yield for my scenario, this is a $135 stock 5 years from now. If you are a bit more aggressive here, you could see this as a $200 stock 5 years from now, because a lot of this return is going to come back from the fact that they're getting a 4 to 5% buyback yield every single year, buying back 6 billion shares when the stock is trading at 7%. This is the best use of their money right now. I like that they're doing that. They should be buying back shares as much. They should be buying back as much as they can for at least the next couple of years, until this gets into that 4 to 5 to maybe low 6% range. And maybe then look at acquisitions. Maybe then look at issuing a dividend, because people seem to like dividends, and that'll get them included in the dividend ETFs and things of that nature. So that's my thought on PayPal. I like it. Don't think the earnings are bad by any means. I get why the stock is down, taking a little bit of a pause. If it takes a bigger pause, if it starts dropping into the low 70s, high 60s, I'd probably pick up more shares. But for now, very comfortable holding. What about you? Are you a shareholder of PayPal? Do you see it as a $100 plus stock pretty soon? Let me know what you think down below. Leave a comment, like, subscribe, all of that good stuff. Thanks for watching, and I'll be back soon with more videos. Bye.